Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go. It's going to be related to commodities, financial topics, and/or wealth topics that we're going to be covering here. So let's dive in. Let's see what people are sharing on social media. If you want to follow me at Finance, and if you want to join our community, finding-value.com, where we go over individual companies, over sectors. I can answer your questions, and you can use the word discount in the coupon code if you want a discount. Coming on down, we've got demand for electric vehicles does not look good. Generous government incentives are disappearing. Infrastructure and price still remain roadblocks. In Germany, sales are set to drop 14% this year. So what's going on with electric vehicles? How come nobody wants them? Is it a convenience factor? Does it suck to try to charge these things up if you're on a road trip? Is there a lot of limitations that people don't want to deal with? That's my guess. John says at 25, I want to be a CFO. At 35, nah, I'm good. Very common. Um, I would say at about 30 years old, that's when I kind of was like, yeah, I'm good here. I don't need to be moving along too high. And it was mainly because the pay differences between grades were not that big. And then I looked at how it looked like dog on a leash style a lot of the upper managers were in a lot of the different areas. And I was like, nah, I don't want to be that. I definitely do not want to be that. You look at this chart. It says how long before gold futures hit 2,500 bucks. I look at this chart, and this chart makes me want to buy a whole bunch more precious metals. Like this chart looks so good. It is a cup and handle. We're breaking out of the cup and handle with good support underneath us. That's like the best time to buy it is when you've got support underneath you and you've got a bunch of runway on top of it. It's by far the best time. This thing looks absolutely excellent. Every time I look at this chart and I see it, I'm like, why don't I buy more? Probably because there's a bunch of other opportunities out there as well. What has been your most bought stock over the past 3 months? What I'll say there is my stocks rotate. Whenever something's in a really good location, I buy a whole bunch of it. And then if it goes up, I stop buying it. I rotate into something else. And then if that stock comes back and does a double bottom or something like that, I buy it again. So my stock, I don't consistently buy the same stocks year in and year out. They generally rotate of whatever is in favor for me. And that is generally stocks that are down. So they may be down for 3 months, 6 months, maybe even a year. And then when they take off, I stop buying them. And then you don't hear me talk about them as much either. So some of the uranium stocks I bought in 2020, I bought them again in 2022, 23, whenever that bottom was. I don't really talk about them much anymore, even on the website. And then you'll see me talk about new companies that are down right now, and they just so happen to be in this area in the precious metals region, is what I'll say. And I've been buying some of that stuff over the past 3 months. When married, I'd like to have one joint account for bills, groceries, one joint emergency savings account, and then our separate spending accounts. He doesn't need to see what I spend at Sephora, and I don't care about his golf league. Any married folks out there have a different take. I don't know. I'm not into this like joint or whatever. It doesn't matter. All I know is I pay for all of the bills, all of the groceries, the mortgage, the insurance. I pay for everything. And whatever money she makes, she can do whatever she wants with it. The disparity between how much I make and she makes is pretty large. So I mean, it's pretty, I basically dedicated my life to saving money and now investing it really, really hard. And my dividend income is more than what she makes at her job. It's actually about 3 times the amount that she makes. And that's across, I would say, all the accounts, which is retirement accounts and individual accounts. I've got some goals that I'd like to attain where my individual account, to push the dividends there a little bit more than having them be in some of my retirement accounts. So, I mean, when I look at this, it depends in your situation, but I mean, what if the guy makes 10 times the amount the female makes? It doesn't even matter at that point. You're just looking at it like, okay, keep your amount of money in your account and spend it whatever way you like. That's kind of the way I look at it. I know a lot of guys, they make pretty good money and they cover all the bills, basically, the guys do. And then the girls, since they don't make any money for the most part, they just kind of do whatever with it. So when you're really young, and I'm sure this person is probably pretty young just by looking at how she's writing this, um, you're kind of equal in the beginning when you're 20 something years old. But when you're in your 40s or something, the disparity could be quite large depending on the paths that you took. John Quake says sorting these major Canada, US uranium mining stocks by their returns in just the first month of 2024 shows double-digit percent gains for all, with the exception of Centrus, which isn't actually a uranium mining stock. So it isn't leveraged to the surging spot price. So we've seen pretty big moves in a lot of the uranium sector. Now, is this going to continue? That's really the question that you should be asking. Is uranium going to continue its move higher? I tend to think it might, but generally, when you start to see these big percent gains, like 50% gains, 30% gains, 20 something percent gains in a month time frame, generally you could get a pullback. But I think when uranium really takes off, I think we are going to make very big moves for month after month after month after month for probably like 18 months. It's going to be a pretty good show for anybody who owns them. I think what's keeping people out of energy is not that they see downside, it's that they don't see explosive upside. Everybody wants to chase what they think could shoot up quickly instead of taking a steady 10 to 20% per year, which is what I see in oil. As they're chasing tech because they're creating narratives that growth will be exponential from here, even though there's a lot of evidence that it may be impossible to sustain in mega caps. What could change the perception of no big upside potential in oil is a supply shock. People say it's an election year and Biden wouldn't risk that, but it might not be in US control. That would be unexpected and totally change the narrative like the Ukraine war did. What could change the perception of upside in tech for forecast revisions? Everybody thinks they're just going to earn more and more. Meanwhile, lots of tech companies laying people off. People inside the industry say it's tight, budgets are closing, etc. Who is right here? I would say that oil looks absolutely fantastic, in my opinion. And I think tech is a few earnings away from a big crash, whenever that's going to be. I think that the valuations are completely too high for tech, and I won't be subjecting my money to that type of risk. I'd rather take the value over an oil, sit it out, wait it out with little downside and some upside potential, than playing it with very little upside potential in tech, given where the valuations are, given how large these companies are, and given what I think the upside move could potentially be. I don't think there's a 10x in any of these mega caps. I could be wrong, but that would put them basically larger than the majority of the world that's out there. To be 10 or 12 trillion market cap if they're already at 1 or 2 trillion market cap right now. I just don't see that occurring. Oil, JP Morgan says $80 with upside. Rig counts internationally are pretty low. Inventories have been drawing globally. Red Sea transits at lowest levels since the Suez crisis began. The Saudis just canceled a bunch of spare capacity. The only worry is the economy rolling over for oil. Um, some other people say, well, why is Saudi cutting if oil is so strong? I think Saudi is going against the United States. I think that they think the United States is manipulating the price of oil. And I think that they are trying to literally stick it to us and drain our inventory levels to just ungodly low levels. I think they're trying to stick it to the United States, if you want to know. I think that they are cutting back on production because the United States is trying to manipulate oil with strategic petroleum reserve releases and maybe even messing with the derivatives market. And I don't know exactly how they're messing with it, but I can tell something's going on with how it's trading in relationship to yields. So I think it's not, Saudi isn't cutting because of weak demand. They're cutting for other geopolitical reasons, and maybe even with the price of where it's at, they're like, we don't want to sell our oil at this price. So they're just cutting it back and they're going to drain inventory until the price rises. They're going to force the move, is what they're trying to do. The correlation is undeniable in terms of global M2 money supply, year over year change, and the S&P 500 index. Liquidity is the stock market. So the movements in the stock market are basically liquidity movements in the market. I took 4 pieces of oil data and indexed them. Here's what the data told me. Oil equipment orders are near the lowest levels of the past 20 years. Oil producer costs, PPI, are at the highest level of the past 20 years. Employment in the oil and gas sector is at an all-time low. To me, that seems like we are at a very low area and a great time to be investing in it. It's a contrarian move. Now, some people will say, oh, well, it's at the lowest level in the past 20 years. Why would anybody want to invest in that because it's down? It's like, yeah, that's why I would invest in it. The sound and shiny object chasers, they chase price. They don't chase value. They don't chase risk reward. They strictly just chase price, running around like a chicken with their head cut off, chasing performance. So it might work for a little while, but at some point, you're going to figure out that your head's cut off and you're just chasing. Just in, an astounding 83% of Americans currently think it is a bad time to buy a house, according to our boy, Reventure Capital, Reventure Consulting. This is more than triple the 27% low seen in 2020 and well above the 37% historical average. Meanwhile, mortgage demand 30-year low in January. Current mortgage demand is 54% below the pandemic peak and down 14% year over year, even as mortgage rates have dropped. Buying a home is now a luxury. Well, yeah, if you're in, this is like the best time to buy a house was all through here. The worst time is when it all squeezes up. You have no inventory, so you have no options. Everything's costly, and you've got bad interest rates. Of course, this is going to be a bad time to buy a house, and that's going to be the perception. Of course. NXE updated their investor presentation with net present value 8 calcs at $100 and $150 a pound. We're talking about 8.13 to 12.8 billion. With current market cap of about 5.7 billion, there's still lots of room to run, even for a giant like NextGen. And here's some of the uranium price, what their internal rates of return are, and the average annual earnings before interest tax over here. And there's some monster numbers. When you get above $100, it just starts to blow up. Big numbers up there. Brian Gitt says, why do politicians lie about wind and solar getting cheaper? The truth, it turns out, is exactly the opposite. U.S. wind and solar prices increased 100% in the last 4 years. It's because wind and solar are more or less nothing more than the components that make it up. So if you were to look at the commodity prices and the commodity prices go up, the price of solar and wind go up. I mean, it's that easy. Not too hard to figure out. Suez Canal is responsible for 12 to 15% of global trade, but amid geopolitical tensions, traffic has dropped by 50%. To make things worse, freight rates have been rising aggressively. This is a major risk to the disinflation narrative, and you can see the big move to the downside in terms of the Suez Canal traffic. And I am playing the freight rates moving up aggressively. I agree with that. Here's URNM. Not many charts are complement by the fundamentals. Here's your squeeze up and your break to the upside, and here we are ripping. He has a potential move where he projected this trend line upward here, and it's up around $167. We are currently trading at 57 bucks. Big move to the upside is what he projects. Dr. Copper, RBC's bullish, top four charts from their recent equity research. There's a supply issue point to deficit and higher prices in 2024. I shared this one earlier about the supply gap that's going out in the late 2020s. You can see this total consumption and incentive price needs to be greater than $4 for more projects to maybe come online. We've got the challenges for miners to growing, and they're talking a lot about the grade decline in a structural treadmill. And that's the average mine grade that is declining over time. And that's going to take a lot more energy to get out of the ground. Then we've got over 200 billion required in the next 10 years for capital requirements. And then you've got the demand, and then you've got the potential supply if capex is spent. Maybe we can make up that difference. I don't really know. I'm tending to think that we can't. It's a time issue, not a dollar issue. JP Morgan, we believe the lows are behind us and continue to see Brent oil trading in high 80s by May. High 80s by May, that's pretty good. With the distinct possibility of crude overshooting our price target to the upside. So they're seeing upside with crude oil, much like me, and hopefully we get that. I'd like to get the dividends of a lot of these companies if oil's in the 80s and potentially 90s at that time. Calvin says, I couldn't sleep last night, and I've basically spent the past 24 hours reviewing data to figure out if I'm wrong on my short tech, long energy positioning. I keep coming back to the same conclusions. Tech is very overbought. Energy is very oversold. He's got an article on Cisco collapsing, much like NVIDIA looks like right now in terms of valuations and things going on. I'm not going to go through and read all that, but I would agree. I think tech is definitely overvalued. I wouldn't say it's overbought, it's overvalued. And energy is undervalued. But that doesn't mean that changes are going to happen immediately. It may take some time. We've got Gary here. He says, I'm just not seeing this recession everyone is predicting. Recessions don't just magically appear. There has to be a catalyst to collapse middle-class spending before a recession starts. Historically, the trigger for economies to roll over into a recession has been a surge in inflation, not an increase in interest rates. By that, I mean the price of oil spikes 100% or more in a year or less. This is too much of a shock for the lower and middle class. They have no discretionary income. They need everything to just fill up the gas tank and put food on the table. Every recession since 1970 has been preceded by a surge in the price of oil, other than the self-inflicted recession of the COVID shutdown. And I don't know. I mean, generally, you get an inflationary move with an increase in interest rates. You get an oversupply of the housing market, and oil generally shoots up during that time frame. So I don't think oil's the big deal. I think it's the employment from the residential construction. And when that starts to turn, that's when you get the recession because people don't have money to spend when they're out of work. And that's increasing from the unemployment from construction. And then you also have the deleveraging and credit collapse from the real estate market if it collapses. But that's what I've got for today, guys. Give me a thumb up for the content, subscribe to the channel, and subscribe to the website if you'd like. Everything still looks all good on the commodities front, at least from social media's perspective. But that's what I've got for today. We'll catch you later. This is Finding Value.